Hi everybody, Dave Kaplan here with Cornerstone Wealth Management. What is going on with the stock market? I'm getting that question a lot lately. So I think that now would be a good time to talk about the market's recent volatility and why reacting to that volatility, trying to avoid the downside by moving out of stocks, might actually hurt your investment returns. First, let me just say that it's completely understandable if you're feeling a bit nervous over the market's recent movements. After all, stock prices, as measured by the S&P 500, reached an all-time high on February 19th and then proceeded to drop rapidly. And within just over 4 weeks, stocks had fallen by 34% before bottoming out on March 23rd. And then the market began a dramatic move the opposite direction, back up again. So now here we are in mid-May, and stocks have rebounded by 30% from that market bottom. Wow. Now, while I can't tell you where prices are going from here, I can tell you that this kind of volatility is really not unprecedented. Here's a great illustration of exactly what I mean. The gray bars on this chart show us percentage gains or losses that have occurred in stocks every calendar year going back to 1980. So we can see that during the financial crisis of 2008, stocks finished down by 38%. And then in 2009, stocks were positive by 23%. But what I really want you to focus on are the red dots. Those dots represent how far stock prices fell during each year before the final year-end results. So, looking again at 2009, at one point, stocks dropped by 28% before finishing the year with a 23% gain. And it's important to note that despite mid-year drops that averaged about 14% over this period, stocks finished with positive returns in 30 of those 40 years. Now, another question that you might be asking yourself is if it would make sense in volatile times to pull out of stocks, wait for things to calm down, and then get back in again. Well, history shows that trying to time the market like that might actually hurt your portfolio's performance. Over the past 20 calendar years, the S&P 500 has averaged a positive return of 6.06%. But if your investment strategy was to move money in and out of the market, and by doing so, you missed just the 10 best performing days, just 10 days out of the past 20 years, your annualized return would have fallen to 2.18%. If you had missed the best 20 days, you would have had a negative annualized return. So the takeaway on all of this can be summed up in 2 points. First, that volatility like this is a normal part of investing. And the second, that being calm and patient during this kind of market volatility has actually proven to be very rewarding for investors. If you have questions about your portfolio or the markets in general, give me a call or contact me through my website. My goal is to provide you with the information and tools you need to achieve your goals. Thanks for watching, and I'll see you next time.